It's certainly been a wild start to the 2016 financial year. So what are the implications of the collapse of the Chinese stock market and Greece's flirtation with leaving the euro? Firstly, to China, and earlier this week the share market fell by more than 8% in a single day, racking up 30% declines since the end of June. This needs to be seen in the context of the super bull market that it experienced in the preceding 12 months and still up more than 90% from where it was 12 months ago. What's more important than the gyrations of the stock market itself is the insight into the Chinese economy's management by the centralised government, with the interventions or lack thereof that have been characterised over the last few weeks by what looks to be a misunderstanding of how markets really work. So the problem with the Chinese stock market was that it was fuelled enormously by rapid growth in margin lending. And it seems to be that the Chinese administration struggled to contain this leverage, and that certainly led to the bubble-like nature in Chinese domestic stocks. So having not regulated that leverage growth sufficiently, what's more worrying is how the Chinese government looks to have tried to intervene to support the market as it rapidly declined. This shows that the Chinese still have a very centralised view of economic management and probably misunderstand both the global nature and the fluid nature of equity markets, and that trying to control market directions is like trying to hold back the tide. What about Greece? Well, it seems that that can has certainly been kicked a long way down the road. The problem certainly hasn't been solved, but it does show very strong commitment by members of the European Union to keep the Union together, and at least for the short term contains the speculation around other economies like Italy and Spain agitating for departure from the euro. The bigger question is, what would be the impact of a Brexit? So if Britain progresses its plans for departure from the European Union. But at this stage, there seems to be sufficient stability within the Union for there to be a continuation of the economic recovery that seems to be taking place. So all of this continues to make equity investing challenging, and when we look at other asset classes like property and fixed interest and cash, it continues to be difficult to find no-brainers from an investment perspective. But I did like an article by US commentator Nick Murray recently about how much you lose when markets decline rapidly. And he makes a very good point in colourful language that where you have a well-diversified portfolio coupled with sufficient liquidity, day-to-day gyrations shouldn't worry you, and in fact they're a necessary part of being a successful long-term investor. So we hope you enjoy the article and we'll continue to actively monitor the economic and market environment to be making the most of the opportunities that present themselves.